Hello, this is Ariana Mears, Assistant Director of Financial Aid at Delaware Valley University, and today we're going to go over how to utilize some federal websites to understand loan repayment and get signed up for the right plan for you. Your first stop is studentaid.ed.gov. Once you're at studentaid.ed.gov, you can see that there's a black banner bar at the top with several types of information. There's an entire page devoted to how to repay your loans. The first step in figuring out what repayment plan is best for you is to use the repayment estimator. You can do so by clicking on this blue link here. Now, the repayment calculator will include all of your federal loans. And for the purposes of this tutorial, we're going to use average loan balances for a four-year private not-for-profit institution. And we're going to base this scenario off of a single household with zero dependents. Now, you can use the estimator if you've logged into studentloans.gov with your loan totals as well. So in this scenario, we have zero dependent children and we're single and filing single. At the bottom, you'll include your adjusted gross income. This is your annual salary. For the purposes of this tutorial, again, we'll use $33,000 as that's the average starting salary for a college graduate. Now, at this time, there's 6 different repayment plans that you can utilize to pay your loans. The first 2 will pay your loans over the course of 10 years, and they're the standard and graduated plan. The standard plan is the default by the Department of Education, and in this plan, you'll pay the same amount of money every month for all 10 years of repayment. The graduated plan, you can see that you'll pay slightly more over the course of repayment, and that's because in this plan, you'll start out very low at $165 a month, and you'll end much higher than the standard plan at $494. In the graduated model, every 2 years, your repayment amount will increase. The theory is that over the 10 years of repayment, your income will increase, and the amount that you have to pay upfront as a recent graduate on the other necessities of life will decrease, such as putting a down deposit on an apartment or getting your first car. Theoretically, over the course of 10 years, you'll be able to afford more towards the end of repayment because you're earning more and you're spending less on that upfront capital. Now, some of you who may be watching are already into repayment or may be struggling with the standard or graduated plan. In that case, you have income-driven repayment plan options. In each of these plans, you can see that you'll pay considerably more over the course of repayment. But that's because repayment has now extended from 10 years to 15 up to 20. On the right, you can see what these monthly payments will look like over the course of your repayment. If you choose to use an income-driven repayment plan, you have to fill out an application every year. This site tells you a little bit more about it, and you can get to that through the studentaid.gov hyperlink with the black bar at the top. Once you're ready, you'll click Apply Now, and it'll take you to the application. Please keep in mind that if you're applying for income-based repayment, you have to fill out this application every year. However, the application is free, and you should never pay a service to do this for you. It takes 10 minutes or less. So you'll fill in the questionnaire, and this will go out to your federal loan servicers, and they'll enroll you in the best plan based on your current income levels. Now, another option that you have in repayment is loan consolidation. Now, I wouldn't recommend using loan consolidation right off the bat as a new graduate. It's kind of like a last resort. And the reason for that is that if you were to ever get into trouble during repayment, let's say you get into an accident and you're out of work for a couple months and you can't pay, you could use loan consolidation as a way to lower your repayment amount. Because what happens when you consolidate is that they combine all of your loans into one larger loan and average your interest rates. In doing so, your repayment period will restart and you'll have another 10 years to make payments on those loans. So it'll restart your repayment period. Another option outside of loan consolidation, if you've really gotten into hard straits, is to request a forbearance. Now, forbearance is a short-term period where you're not making payments at all towards your loans. However, they are accruing interest. So you want to utilize forbearance as a very last resort. And there will be a follow-up video about that in particular. Thanks for watching and tune in for the next one.